John Carney, Breitbart News economics editor and finance editor. We've got Taylor Riggs, co-host of the Big Money Show, right here on Fox Business. I don't know what those. I don't know what you're telling me on the screen, but I'm just going to go to you guys. So what? Okay. So the inflation rate came in a little softer. I get it, but you're still left with the average working person over the duration of Biden's presidency, which is how things look at it, how people look at it. CPI is up 20%. If I'm not mistaken, off the top of my head, groceries up about 20% also. Energy up something like 35 to 40%. Gasoline, once upon a time under Donald Trump, was $2. I know it was down in May. That was a big reason as I looked at the CPI number, but so what? So what? I can't get excited about it. I'm sorry.
No, I think you're making a good point. You're highlighting disinflation, which is the slowing rate of increases, versus deflation, outright price declining, which is what we are not seeing. Still, I would say, and John, feel free to disagree with me, that the Federal Reserve and the markets today took a big sigh of relief when you were getting a slowing rate of increase on inflation. So yes, prices are rising, but they're rising less quickly
than
they were.
That's a fair analytic, empirical point. I agree with that. I think that's right. It just doesn't excuse the sins of the past 3.5 years.
I agree.
You know, and this year, John, started out on a very rapid rate of inflation. I mean, it was like it was coming back. Now, I don't know whether that is stopped or not. As I say, it looks like a lot of energy prices coming down, but you tell me. But the point is, we had almost a 4.5% annualized rate of CPI inflation the first 4 months of the year. This being the 5th month of the year, you got some better relief. Okay, I get that. Taylor speaks the truth on the numbers. What say you?
Yeah, no, this is exactly why Wall Street was very relieved and the Fed was relieved to see these numbers, because the danger was that inflation would keep reaccelerating. I will say, though, when I looked at these numbers, there's a little bit troubling statistics in it. If you remember all the way back in April, we had soft retail sales. And so what happens when you have soft retail sales in April, you then get soft price pressure in May. So what we're seeing is actually the softening of retail sales in April led to low inflation in May. That disrupts the immaculate disinflation story, because if the only way we can get inflation down is to soften the economy, that raises the risk that we could be headed for a recession, because if retail sales keep falling, that will put us into a recession.
When's the recession, John?
I don't think we're actually going to have a recession until the Fed starts going, when Donald Trump gets in office, they're going to do everything they can to throw the works at him and try to, screw up the economy. But I actually don't think we're headed necessarily for a recession, in part because the Fed, I think the clearest path to a recession was Fed cut too early, realize they have to raise rates. That puts us in a recession. If they hold, we'll be okay.
So I'm in a mean and nasty contrary view. You want to know why there's no recession? I'm going to tell you why there's no recession. Profits.
Yes.
Profits are the mother's milk of stocks and the lifeblood of the economy.
Bingo.
Do you want to know why there's very strong profit numbers?
Tell us.
Because Donald Trump cut the top corporate tax rate from 35% to 21%. And despite the fact that Joe Biden and all his advisors have been pulling their hair out for 3.5 years, trying to take that back, the country has prospered for the very reason Trump's corporate tax cut. Profits come when you have lower tax rates. The inflation has hurt them. The interest rates have hurt them. But at least on an after-tax basis, 21% marginal rate, which is what Trump put in, is better than 35. Now, I mean this. You think I'm being ornery? I'm not. I'm being analytical. It's one of these, people don't want to talk about that.
Well, and I think it's a good point to talk about, because a lot of people will point at that and say, oh, see, corporate. So the other side will talk about corporate greed, right? And profits are because they're raising prices on us too much. I would argue, and we've talked about this a lot, grocery margins are only 2 to 3%. Grocery stores barely make any money. But you're right in that sort of the rising tide lift all boats. If you can cut the taxes on corporate rates, it will filter into higher wages for employers, because these companies have more money to spend.
You don't have to be you're an empiricist. How's that? You follow the facts, okay? I tend to be a wee bit more political, but I still have facts in my argument. I'm just telling you that lower marginal tax rates help profits, which help the economy. I don't think this is a booming economy, John, because the business side is not booming. I grant you the consumer side is basically held up with some signs of weakness, but I got one for you, too, before we go out. You have a $1.7 trillion budget deficit. Basically, I'm going to call it $2 trillion as far as the eye can see. Okay, if I'm right, it's close. Now, you have a 4% unemployment rate. You have a 3.4% inflation rate, still above the Fed's target. Am I right? I'm no one saying anything. I'm looking at the numbers here. John Riding and Conrad DeQuatros.
Our favorites.
My old kids, they're the best in the business. I'm just saying, how can you have massive budget deficits with higher than necessary inflation and a lower unemployment rate? John Maynard Keynes, who kind of sort of invented post-war macroeconomics for better or worse, is rolling over in his grave. That's the point I want to make. This is a crazy thing. Biden is spending like there's no tomorrow, and the Fed is going to wind up having no choice but to enable him.
Look, the Fed just said today, they brought it back from saying we're going to have 3 cuts to 1 cut. But more important than that, and very related to exactly what you were just saying, is they looked out into the future and they said, you know what? The long-term Fed funds rate is not going to be 2.5%. They raised the longer-run projection to 2.8%. That's because the deficit is going to run so high forever that they have to have higher interest rates to fight that inflationary pressure forever, Larry. We've said before that we won't see a rate cut in our lifetime. Someday they'll cut rates, but they're never going back to 2.5.
No, they can't do it. I mean, you can't have on the one side federal spending like there's no tomorrow. I mean, federal outlays as a share of GDP are running something close to 24% of GDP. In peacetime, that's virtually a record. It may not be quite a record, but it's darn close to a record. If you have these budget deficits of 1.7 to 2 trillion of GDP, that's, what is that, 6-7% of GDP. In peacetime, really, with a 4% unemployment rate? We don't have a depression. Right? These are depression arguments.
What we
but they're
have
going to wind up as inflation arguments.
We have an inflationary party right now in the United States.
Right.
They're called the Democrats. They're pushing us into inflation. The Fed has to fight it with higher interest rates, and that's exactly what's happening. Push the deficit up forever, interest rates and inflation stand.
Make 3% budget deficits great again.
I have to process that. Okay, it's probably a good idea. Anything Taylor says is a good idea. John Carney, terrific. Be sure to catch Taylor along with her co-host Brian Brenberg and Jackie DeAngelis on The Big Money Show, weekdays at 1 p.m. Eastern, right here on Fox Business. And don't forget Breitbart's. What's your daily thing called?
It's Breitbart Business Digest. It's free, comes out every day.
It's a fabulous product.